let's move quickly on to our main man, Jabari Porter, the main event, the head honcho, the main entree, the meat and potatoes.
Not
Help
my
me out
house.
here. Any other?
The bee's knees.
The bee's knees.
The mama's pajamas.
A lot of Mahama.
Yeah.
So CIO, cool title, City of Chicago.
Yeah.
So you were basically managing or helping manage an $8 billion portfolio for the City of Chicago. Don't lie. At some point, did you feel like you were a big swinging dick? Like, yo, I'm kind of important here.
No, well, to be honest,
Did you walk into Ram's office sometimes and be like, hey, you manage it, man?
To be honest with you, I think maybe the first week I started like the latter part of December, so everyone was kind of gone. In the first week, I was like, "Oh shit, what did I get myself into?"
What do you mean everyone's gone?
Most people were gone.
Like
they
vacation?
were on vacation.
Oh, you're alone?
Yeah, I was alone.
You're the only guy in the
Yeah, I
city,
was-
city hall. It's just Jabari sitting at a desk by himself in his
Essentially.
underwear.
Was it intimidating?
I mean, there was a lot. Yeah, I mean, I don't know if intimidating. It was somewhat overwhelming because you've got these systems and things were could have been in a better shape, and that really informed how I conducted myself in office. I think one of the things that one of the thesis that we had, and Kurt had, and certainly I shared in that idea that simply because it was a government office doesn't mean that it had to be viewed or behave or treated like one. I mean,
Look down upon,
look down upon, and
we don't have to show up at the right time. We don't have to,
the way I tell my kids this, I said, you practice how you play. You can't just assume that you're going to play well. You got to go in there and you do everything right, and that was my approach.
Great advice. Practice how you play. I like that.
Yeah.
Have you ever heard that, Michael Kim Lewis?
I've never heard that.
I like
practice how you play. I mean, I've heard practice doesn't make perfect. Practice makes permanent.
Practice doesn't make perfect. Practice makes permanent. That's
Yeah.
good.
I like
It's pretty close to that idea. Okay, cool. So, City of Chicago, walk in. You're alone the first day. You're like, all right, what am I gonna do with this $8 billion? Maybe I'll just put it in my pocket.
It was peaceful, actually.
Yeah.
And
And you were there for 2 years.
About 2 years, yeah.
And and then before that, you were at Northern Trust for 10 years.
I was there. Yeah.
And what was your role there? Were you helping?
So I worked on the bank portfolio.
Bank portfolio.
Yeah, there were a few portfolios. Roughly about $40 billion portfolios.
$40 billion. Is that going to be mostly
It's all fixed income.
Is that going to be mostly clients of Northern Trust's
No,
money?
this is the bank. So
The bank money.
yeah, the bank money.
And what does that mean? The bank money, like shareholder money?
Ultimately,
right.
Ultimately, I mean, they own it.
But it's the bank portfolio, like basically the war chest that the bank has that they built over years, and it gets invested.
Essentially.
Got it.
So the balance sheet is, in financial institution, the balance sheet is the fortress.
Yeah.
If that goes away, like
The whole bank goes away, right?
Everything goes
Yeah,
away.
their factory, their manufacturing facility, all that stuff, in that sense, is the balance sheet itself.
Exactly.
Right.
Exactly. That's the
Did you get that, Michael?
I feel like, what do you do with their money? They trust it to you, and you just direct it. You invest in companies, or what do you?
So we basically make loans to companies, or we buy pools of mortgages. So the hardest thing.
Yeah, they'll lend it to companies.
You're
to
a bank to companies,
and then also lend it to people to buy homes.
Okay.
Yeah,
Mortgages.
Yeah.
All
In
right.
an indirect, like, well, the bank did that too, and then we essentially did that on the desk, but they're pools of mortgages.
Yeah, it's more commercialized.
Oh, wow.
It's not like they just call up John and be like, "Hey, John, do you want $100,000 for a house?"
Yeah.
There's a system of pools.
Okay, and it's not like you're throwing all the money in Google or like
no
specific.
And there's risk. Stuff. I mean, there's risk controls and stuff like that. So
You can't go too crazy. with it.
yeah. Sometimes too much control.
Did you ever have? What's been like? Either at the City of Chicago or let me just take a step back. So $8 billion there, and there was $40 billion at Northern Trust.
Yeah.
And what's a typical transaction day at Northern Trust or at? Let's start with Northern Trust.
Transactions were a lot bigger.
Right, because you're managing a bigger bank portfolio. So you might walk in one morning and you get the message of like from the higher ups, like, "Hey, we want to put $250 million to work." We
would make that decision. We would say where do we want to be in the market or what's attractive.
Okay.
And essentially, it would not necessarily totally informally, but depending on what our how much capacity we had. We could in a month we say, okay, well we need to move $500 million or something like that.
Right.
To allocate that. And then,
So over the next 30 days, we're going to try
the next 30 days,
try and invest $500 million.
Yeah.
Okay.
Yeah. So then we would look for opportunities and say, okay, well, we already have an idea. I cover certain markets, and say,
Right.
okay, well, I think these are really good opportunities, and depending on where you think the economy is going and what you think the long-term objective
Right.
is for the investment, you say, okay, well, I think we should move money here. It's yielding better. The risk is X.
Right.
I think this is a better play. We had European counterparts that we would transact it. We would communicate with. And we just go around saying, what are you looking at? What do you see? And, if your deal looked better than my deal, all things being equal, we'd go with your deal.
Did you invest internationally?
Yeah, we had some initially we did it out of Chicago, but then we moved that to our London office. But
Is that right?
Yeah.
The Northern Trust bank portfolio money is traded out is invested out of London now.
We have some London folks too.
Got it.
That do that. Initially, but we weren't heavily in that space at that time when we were doing it. We were essentially doing. I don't want to get too technical here, but we were essentially doing sovereigns and kind of very high quality
government, national,
government supras and
Yep.
sovereigns and
Yep.
stuff like that.
Makes
And
sense.
kind of
So like they'll loan the money to the government of Germany or the government of Spain or whatever.
Like buying bonds?
yeah. So
There you go.
Yeah.
Okay, I'm
Bam.
catching up.
Bam.
I'm curious to know, what was the big, running all that money for the city of Chicago? You're on a team. It's not just you. Is there
But he's the CIO.
Oh, okay, so
I'm
they
the one they
report.
blame.
They
Yeah,
report
if
to
he
you.
if he loses a bunch of money, he's the one who gets castrated.
I want to know, what's the biggest with money? What's the biggest has there ever been just a huge investment? You're like, what were you thinking, Dale?
I told you
Why would we
sell $100, not $100 million.
Yeah, it's like.
Fortunately, not really not under my watch.
Is there ever a dramatic loss, or is it just kind of slowly over time?
No, I mean, you have controls in place, and there are. So we had before I got there. So I not necessarily something a jacket that I have to wear, but before I got there, the trades actually look pretty good now, but before I got there, they had a lot of very long duration positions, and so when I was when I first got there,
Do you know what that means, Mike?
No.
okay, I'm sorry.
It's all good.
Okay.
They took some of that $8 billion
Yeah.
and they lent it out to people for a long time. Like instead of for a day or a month or a year, they would lend it out for 20 years, 30 years.
30
Okay.
years, yeah.
Which is not necessarily bad. Then you get a higher interest rate.
You do, but and here's where the pain kind of came into place is when interest rates are going up. They lent the money out at, let's just say 3.5%. Now that same interest rate is going to be 4.5%. So if I try to sell my bond, they're going to say, well, I don't want to buy your 3.5% bond if I can get a 4.5% bond. So the price of my bond goes down.
Yeah, the value of
Okay.
those investments.
It's out of reach.
It's out of reach. Yeah.
Okay.
So
I just recently learned about inverted yield curve.
What?
The bonds.
You learned about
I
that?
watched a Vox video. Thank you. Shout out to Vox. They've got great
it's
news
a good
videos.
the Vox
Like
is good.
predicting the recession. It was the video.
I
Oh,
can't
really?
believe-
Yeah.
Really?
I
How
can't
the
believe
inverted
the
yield
average
curve.
person is talking about the inverted bond curve. I can't
Yeah.
believe
They
that.
should- I'm glad they are.
Yeah.
You like that?
I think my
I don't mind it. I don't mind
No,
it.
I just want to know when the shit hits the
like it
fan.
too.
That's like it
just think
seems
it's
like
weird.
it seemed like they described it as a very good predictor for the recession.
Yeah.
It's the only time
Yeah.
Yeah.
when it goes down, shit hits the fan. Like, okay, that's important for me to know.
Did you know about this Vox video?
No,
It just came out
was
this
that,
week.
Was that the Everything Explained? Is that
I think so. Yeah.
They've done. I mean,
It's
I
on my
watched,
YouTube feed.
Yeah.
I watched a couple of those things,
seen
and they're really good.
Shout out to YouTube.
Yeah,
Pay us for
They
that
could use it.
YouTube.
yeah.
Oh man. Okay. Cool. So you've never. So okay. You're saying.
So we didn't have
there
any-
were some losses there in those long duration.
Yeah, those were
longer.
probably the biggest frustrations that I had in the portfolio, and trying to get out of those. And then what we essentially had to do, because in that environment, interest rates are going up, and you've got these long positions, so your portfolio is starting to look worse and worse and worse.
Yeah.
So we did stuff the one thing when I got there, I think we sold $100 million or something, and then we started repositioning the portfolio. And then what we did is when we got runoff, we would invest that into floating rate, and we did some structured products, some ABS stuff. So we were able to. The whole thing is trying to engineer the yield that we want to get and eliminate or reduce the amount of risk of having those long positions.
Okay.
Yeah. Engineer yield meaning trying to make sure they get higher interest rate, the highest interest rate they possibly can.
Okay.
Without the risk.
Without the risk, yeah. Okay, so has helping manage an $8 billion portfolio for the city and for Northern Trust, have you become a billionaire yet doing all this?
You know what? I'm a quiet billionaire.
Oh, quiet billionaire. Okay, perfect.
Yeah. So
what's that mean?
No, I'm not a billionaire, unfortunately. I was telling when we were talking the other day. I said, I work too hard to be a billionaire.
Yeah, that's right. Crazy, right?
Yeah.
Me too,
crazy.
brother.
Yeah.
Me too.
So
That's
how
why
do
I
you
can't be a
work?
billionaire.
Yeah,
I'm
there's
just
an
hustling
inverse
too hard.
relationship. You talk about inverted curves. There's the
If it
inverted.
weren't for my work ethic.
Yeah, I'm too busy to have a job.
How much money did Chicago make off of you? I mean, imagine like if you're ever
think so.
applying
You
for the next job,
kind
you
of
could.
prostituted him. What do you mean make off of you?
Well, I just imagine him at the next like job interview or anytime you want to run
That's
a company.
right.
People want to
Yeah.
know, why should I invest in you? Well, because I made Chicago X
Great
amount of
question.
dollars.
How would you answer that?
Like,
How much money did you help the city make?
yeah, how much did we
So
make off you, bro?
we made about $152 million, I think, last year.
152?
Yeah.
Wow.
It's a good number.
Yeah. It was a good number, and it was.
You were able to put it in your pocket, huh?
Yeah. No, I think other types of politicians or politicians.
Yeah, they figured out the way. It's not you.
Yeah. They don't.
Speaking of, did you interact with Rom quite a bit?
No. I mean, I mostly dealt with his Department of Finance.
His Department of Finance. It was just be at like galas or like events or.
Yeah, I mean, I was at something for Fifth Third, and he was there, and it's.
So it's not like So it's not like him coming in your office. Jabari,
No.
how much did you make today?
No.
What kind of work?
I need those papers on my desk by AOD.
What's AOD?
EOD, end of day.
Oh yeah.
Come on. I'll walk you through this.
I
I'll
was
walk
like,
you
wait a
through
minute, that
this
sounds like some sort of mind device that they put in.
Sounds like something you diagnose a child with.
somewhere. Suffers from EOD.
It also sounds like something a woman might use to prevent pregnancy. That's an
IUD, yeah.
Yeah. Oh, an IUD.
I'm curious, Jabari, with your position when you manage funds like that, like for any private company, you probably take a commission or a cut, but it being in a political or public position, is that just a flat rate?
It's just a flat rate.
Oh,
And I mean, the is right. But
Make that job
so it's
commission.
like, yeah. Why work harder if you're?
Well, I think I take your point, and I think probably that should be the case. But I think the way I look at it, when you suit up, you just play. I don't like. I didn't have a certain. I wasn't like working harder. Probably shouldn't say this for the Northern than I was for the city of Chicago. I had the same. Type
Actually, why shouldn't you say that? I think. I mean, City of Chicago is obviously going to love that.
Yeah.
But I mean, I would think Northern would want a dude to work for
They
them.
would just put
who's-
on the suit and
play,
suit up and play.
No matter what.
Yeah,
I don't care I don't care whose billions I'm managing. I just make you some cash, baby. I just make it rain.
Wow.
Yeah. So
right.
that's kind of how I look.
All right, so here's the big question. How have you been able to, this is the $1 million question, literally. How have you been able to in what ways have you figured out, like in your years of managing cash, and what have you figured out, maybe for yourself, maybe for others, where you can like make extra money given your experience? Have you been able to like, use the experience of moving lots of money and transacting it and making money? Have you been able to use that experience in the real world for yourself in any way?
Yeah. I mean, my portfolio, but it's not $1 million.
Well, what the hell you doing, Jabari?
No, I mean, it gives you, the way I kind of think about it is the red and the blue pill, I think it was.
Oh, yeah.
So you take the pill and then you see things that, otherwise, and it's not as simplistic as that, but I mean, to me, just investing is about looking at a series of patterns and kind of being in front of those. So you think about inverted yield curve, or you think about trade policy. I just think kind of writ large, like where are things moving and where are opportunities, and then investigate and see how I can exploit those. So, I mean,
We need to get you to be using that investment philosophy and investment experience you have for yourself. One thing that helped me working at JP Morgan and being comfortable with bigger numbers. You know, I mean, speaking of trade mistakes, I've had some mistakes that cost a lot of money.
Ooh.
Yeah. There was one time.
What kind of stress is that when you lose other people's money?
It's hard. In this case, it was the bank's money I lost, and I had to go back to the client, hat in hand, being like, "Yo, I thought you wanted to do $100 million trade. I just realized you only wanted to do a $60 million trade."
Oh wow.
Yeah.
Well, those when I was, I mean, those.
That's a $40 million mistake.
Yeah. And then there's been the way it works in the bond market, it's not technically a $40 million mistake. It depends. Because if the market
Did the market move against you?
It did.
Okay.
$250,000.
Okay.
Well, the real loss was $250,000.
Oh, okay.
Yeah.
That's
that's not that bad.
Yeah, it's not that bad.
No,
That's a Tuesday.
Don't the wipe his ass with $250,000.
Yeah.
It does. I mean, I traded a bond once and didn't. We had a hedge, and our systems weren't that sophisticated, and so the hedge remained on, and so.
Oh.
Yeah, and that was.
How long?
Yeah. Long enough where I had to write a memo.
Oh, yeah. Do you remember what the number was in the end?
Like an apology?
No.
No,
just,
like-
you have to explain, like, you know,
this is what
basically
fucking happened.
Yeah. So,
I
What
screwed
had
up.
happened was...
well, yeah.
What happened was
Yeah. So you
me, right?
Do you get fired for making mistakes that
It
big?
depends on how big it is.
Depends on how big it is,
my
and
goodness.
it depends on what kind of. In this situation, is kind of a system issue as well. So, and that's part of the memo. Here's kind of you have to, dissect kind of what happened.
Yeah, and document it.
So it's like Monopoly when they have the bank error and you get $200.
It's kind of like that. Man.
Yeah.
So it went against you or did it go in your favor?
No, it went against me.
Do you remember the number?
I don't remember the number. I remember another.
It wasn't like millions.
No, it wasn't millions.
Yeah.
They would have told me that. They would have threw me out of there like
Yeah.
Jazzy Jeff.
Yeah. I like Jazzy Jeff. DJ Jazzy Jeff. What was I saying before? So with JP Morgan, so I made that error. But then you get comfortable with numbers. When I was able to save up enough money in the crisis, in the recession, I was like, look at this house. I found a house in Hinsdale, Illinois that was like half price of what they built it for and half of what I thought it was worth. And so I was
Out in
like,
the burbs.
Out in the burbs. And I was like, yo, I'm going to buy that house. And so I went in and talked to them about, it was on short sale. So they were like desperate. What
What year is this?
2009.
Oh yeah, that's
Good time.
when things were
It was a good
You
time.
can find a house in a Cracker Jack box.
yeah.
Exactly.
So you didn't buy the home for yourself. It was an investment.
And I got someone living there today.
Wow.
You
So
know,
you're a
living
landlord.
There, you know who's living there today? Wait, should I say that? No, that's private. I'm not going to say that.
We have to bleep them out.
Basically, I'm not going to say it. Never mind. So you get comfortable. And I thought maybe you might have had some of those experiences where you get comfortable with the bigger numbers, so you're able to make, real estate investments or other investments where you're comfortable doing. But you haven't have you played much in real estate?
No, not in real estate. I don't want to be a landlord. The bond market is where I'm comfortable in. And to be honest with you, when we were talking the other day, and Mike was saying, could you manage money? And I said, I can't even afford to manage my own money. I mean, the bond market is a billion dollar market. I mean, there's
trillion.
Well, trillion. I mean, you can't play in there unless you have like billions.
Oh yeah.
But it's a trillion, a multi-trillion dollar. It's bigger than the stock market.
Yeah.
So like to play in there, I just I don't have the skis to do that, and so you have to figure out ways to do it, and that's why I said I'm not even rich enough to hire myself.
It's crazy, man. I mean, we learn all these skills in the world of finance and the bond market, and then we come out to the real world, try and use it.
You said
it's not there.
What is proximity basically a private version of what you were doing publicly?
Yeah. Essentially, yeah.
Right.
So
I got a slogan for you, by the way. Rich by proximity.
That's pretty good.
Yeah.
I might change my name.
Get
to
rich. Yeah.
That's good too.
Yeah.
All right. So people who are listening who do want to get involved in the bond market, what are some slick things you've learned how to like boost yield or just make a little extra cash, or like this year's been a great year if you're a bondholder,
Yeah, it
obviously,
is.
because
It
there's
is
been a big rally in bond prices.
Yeah.
But like, over the years you've got to have like picked up
So
some slick things.
I usually play in ETFs.
ETFs
Yeah.
with the bond market.
Yeah.
What are some examples?
So
ETF for you novices out there means
exchange traded.
I was just seeing if you knew. I was just seeing if yeah.
Nice. And by the way, that's like basically a collection of stocks or bonds that are all packaged together. Like it could be Google, a loan to Google, a loan to Apple, a loan to Facebook.
Okay.
But it's all packaged together in the form of a stock, and you can just buy it on the stock market.
One stock that applies to multiple companies?
Exactly.
Oh, wow.
It's this new piece of technology called an ETF.
Okay.
And it's really it allows for more agile kind of execution. They're liquid. They're very liquid, unlike bonds. Bonds aren't that liquid, or relative to stocks, but
okay.
There's varying degrees.
So it sounds like it might be more volatile, like a.
It should be. You should overall, because you're pooling all these things together, you should experience less volatility.
Yeah.
Okay.
What are some like trade secrets that you figured out that might, if a person were to get involved in the bond market, things that you know are ways to kind of eke out or squeeze out a little extra cash?
Well, I mean, I would hope they hire a professional.
But if they're small time, right? I mean, like for example, like
do you have to be a billionaire to get into the bond market? Like how?
Well, not if you have ETFs, or you can have like a couple $100 million.
But even like you can go on Schwab and buy muni bonds for O'Hare Airport or whatever,
But you're going to get. I mean, if you could do that. You could do that, but I don't know. I mean, as a practitioner. Oh, sorry. As a practitioner, I mean, I think, the way I kind of think about it is, it's just like anything else. Professionally, like you have to. When I said you have to practice how you play, you can't. I personally don't think that you can just kind of come in and push a button without doing the homework. I do a lot of homework. I mean, I read. My wife would say I read constantly, and when I'm looking at on a professional level, when I'm looking at investing in a bond, I'm trying to figure out basically when is my money going to come back home.
Right.
With the ETF, it's slightly different, where you're just looking directionally. So if you're aware of kind of an inverted yield curve and what the implications of that are, then you could play that in an ETF.
Right.
For example, there's mortgage-backed security opportunities there in ETF form, and you can do that. But a lot of that, you have to kind of know what you're doing. I mean,
to feel comfortable.
Feel comfortable to hit that button and to understand, like, okay, well,
what am I really doing here?
What am I doing? This feels good right now because this is my thesis. And I mean, in portfolio management, you're not always right.
Right.
You just have to be right more times, or the weight of your rightness has to be bigger than the weight of your wrongness.
Yep.
If that makes any sense. But I think it's an involved sport, and I like I said, I think the ETFs are a way to do it if you want to be kind of a passive kind of investor and kind of buy in May and go away or whatever.
Buy in May and go away. Yeah.
And then you probably want to like the ETF, like the aggregate ETF for bonds, if you think bonds are the right play, or if you want to buy equities, or if you're feeling that the economy is moving towards an expansionary period, you want to probably be in growth or high yield. Kind of the bond version of growth.
Would you think there's a way to like for regular investors to get into like munis or a high yield that would get them this extra return and it makes sense for them, or is that just something regular guys shouldn't be getting involved in?
I mean, everyone has a different degree of comfort
with the risk.
With the risk, and I mean, when everybody's making money, everybody's happy. It's and most investors, to be honest with you, even the volatility, particularly with respect to fixed income, that's when most investors kind of hit the pause button and or hit the eject button and get out.
Right.
And that's probably when they shouldn't. I mean, that's the thing with bonds. Kind of the term in bond in the fixed income world is I'm not worried with a return on investment, return of investment, and very little.
Say it slowly. I'm not
so much concerned with a return on investment, but return of investment.
Return of investment. Yeah,
because
principal.
we're lending money.
Right.
You want your principal back. So
In the very least, yeah.
Yeah.
And hopefully you get some of that interest on top.
So if you're experiencing that volatility, if you have a view or a perspective when you bought it on either the market or the individual security, then you can, in most instances, you can make a more reasoned approach and decision. But if you don't know, then you're going to say, "Oh my God!" Speaking of situations, I remember. I shouldn't say this.
Use different words, different names. Come on, baby.
I'm excited.
No. Okay, well,
We want names.
You heard about some dude at a different company, right?
There's a situation. Well, okay. So I told my sister, hey, look, you should buy this, this security. It was an equity, and I bought it too, and it just
The story sounds pretty safe so far.
Yeah, it's
Why'd you want her to buy it?
No comment.
All right, you were feeling pretty good about it.
I was feeling very good about it. And so I said, okay, this is, you should buy this too. And so she did it. And the thing just tanked.
Oh no.
Yeah. But it tanked, but the market was moving too. So
okay.
If you look at the delta between that and the market, it was bad, but it wasn't.
Can you see how much that decision cost you?
And her.
Well, her is what I was worried about.
Yeah, right. Yeah,
so, she's calling me and, oh my God.
Should I sell Jabari?
Yeah, and I said, just hang on, And there's just some bad news that came out.
Mm-hmm.
And I hung on to it.
Yeah, if you hung on to it till now, you're probably fine.
Exactly. And so I hung on to it for a long time, and I was, fine. I made, good money on it.
It did eventually come back?
Oh, yeah, it came back.
Did your sister hang on?
Well, that's the thing. So I called her. I said, hey, look, you should sell that security app. She said, I sold it 2 weeks after. I'm like, what are you doing? What are you doing? I'm like,
we had a guest on last week. He calls that permanent destruction of capital when a person sells in the middle of their loss. Permanent destruction of capital. That's the worst thing a person can do.
It was the worst thing. And it's like, I'll never do this again.
Damn.
And I'm so you have to have the stomach and,
risk tolerance.
You have to have the risk tolerance. And that's, some of that comes from understanding what you're doing.
It's like the only failure happens when you quit.
Yeah. You got to run through the tape.
Yeah.
I think we killed it with the sports metaphors today.
Yeah.
Jabari Porter, thank you for coming on, my man.
Thank you.
Boom, Michael Kim Lewis.
Yes.
JD to the Dolder.
Hey. I'm here.
Thank God.
Yeah.
Thank you all for listening. Thank you all for being here. Peace.
Have a good night.
Peace.